Yep, same on my side. There we go.
Hey everyone, welcome to this webinar. I think we're at number 20 today. If you're just joining us, then let us know. We'll start here in just a minute here. We're going to have Greg Huebner present his 59 unit deal. So we're excited about that. At the deal desk for a little while, and I don't want to give away where it was, but it went away, shall we say. So welcome to the deal analysis webinar number 20 here. I'm real glad you can make it. So, Greg, why don't we just start? Just briefly introduce yourself,
Sure.
And then we'll jump into the deal.
Absolutely. So my name is Greg Huebner. I am based in Lawrence, Kansas, right in the Midwest, about 30 miles outside of Kansas City. Spent about 6 years in Australia as part of my professional career at a software company, building and leading a region from the delivery side of the business. So I've been in real estate. My dad's been in real estate ever since I could remember. I've owned property since 2004, smaller, 3-4 unit type properties. Took a pause from that when I was overseas and just ready to jump back into it. I got in touch with Michael, and it's been great working with him and his team.
Yeah, that's awesome. Thanks for that. And you've been very busy. You've submitted a bunch of deals to the deal desks. Like I said, some of them went away. You're working on other ones. So you picked this one. I wanted you to present one of these deals. It's always more fun to have Deal Makers Mastermind member present one of their deals. So give us kind of a big picture overview about this property, and then we'll crack open the SDA.
Yeah, absolutely. So this is kind of bread and butter, 59 units in a Texas large city, a really tight rental market, and there's really good jobs in the immediate vicinity from major industry, manufacturing, and production. So not necessarily white collar, but good stable blue, and as a property manager said, gray collar jobs. So $50,000 to $80,000 a year production level jobs, in a really attractive location just off a major thoroughfare.
That's awesome. And if you're just joining us now, this is a deal analysis webinar number 20 with Greg Huebner. He's going to talk about his 59 unit deal. If you're just joining us, just let us know where you're calling in from. And yes, Greg is the deal master. That's right.
Thanks, Dino.
That's awesome. All right, Greg, well, crack open the SCA and walk us through kind of the 10-minute offer. Marketing package just came in. You don't want to waste. Now, I know you're very detail-oriented, so you probably spent way more time than 10 minutes on it. But assume for the moment that you're not going to spend more than 10 minutes on it, and you just want to get back to the broker really quick and say, look, man, this price isn't going to work for me, but here's what would, and here's why.
Absolutely. Yep. So here's the marketing package that I got. I'll make it full screen here. Nice, beautiful picture of a pool, and there you kind of see the buildings on the outside. Not a lot of deferred maintenance on the property, which is really positive. Let's see here. So this is kind of the pricing information, initial pricing. The big thing was the occupancy at about 88%, which did provide some restrictions, which I'll go into in just a little bit. But there is a large value add upside to this deal in particular. And the rents were fairly modest. The unit sizes were actually quite large, if you can kind of see that, over 1,000 square foot, and still able to get mid 80s for the current quality of from a rent per square foot perspective. Some more pictures here. Here's the breakdown of the units here from a 10-minute analysis standpoint. So primarily 1 bedroom and 2 bedroom units there. And getting reasonable rents already.
Yeah, it looks like a nice property.
Yeah, it really was. I toured the place, and that's it was a really nice property. Like I said, there wasn't any foundation cracks or anything like that. A couple of the roofs have been replaced already. A couple of the water heaters have been replaced already. So they were doing the maintenance as it needed to be done, and there wasn't a lot of deferred maintenance. So I'll stop right here, and because this is the information. This is a summary here. The modified actuals were from a little bit old. It was a December T3 report there. So let me just stop right there. I'll bring over the SCA, and we'll hop right into a 10-minute analysis here.
10-minute offer.
10 minutes. Yes, I know. So, I won't worry about the top part for right now. But here, coming into the bottom part here, so they gave us $620,000 for gross rents. So I plugged that into the SDA, and they gave a a adjusted gross potential rent, which I equated to essentially the effective gross income of that wasn't it. It would be the vacancy piece of that right there.
Greg, see if you can zoom in a little bit so we can see the numbers a little better. Yep. Go to like to maybe 130 or something. Yeah, perfect.
Yep, there we are. All right, perfect.
Yep.
So, we got the gross potential rent of 620,000. The way they kind of broke this out, they took the loss to lease out first. So they didn't give you an actual number there. So I had to, basically calculate that myself. And then they added in a few concessions, as well as they had some Section 8 payments there. So I plugged that into, and so basically the total rental income, it matches up to the effective gross income slightly. Right. I had to adjust a little bit because of additional loss to lease and this from another financial document that I had. And then the other income was just under 90,000. But from there's my note right there. It's pulled the data from the financial docs, and that includes the Section 8 income, which from the deal desk, you had me move back up into the gross or the effective gross income instead of other income. Right. It's actually rent. Yep.
Bottom line is the total net income matches what was provided in the marketing package. So that's kind of what you did here. Okay, got it.
Yeah, exactly. Yep. And so as we go into the expenses here, they kind of break it down into controllable expenses and then non-controllable expenses. So I basically just copied the values across. You can see the payroll numbers there, G&A, the repairs, and essentially the total expenses, 314,000, matched what was in the T3 there. And so I got the same net operating income. They had a $250 replacement reserves, which is fine. I think I bumped it up to 300 from a conservative standpoint. And after I penciled this out, I was like, put a 30-year loan on it, reasonable interest rate, a 1.81 debt coverage, and they wanted I think they wanted about 3.3 for this one, which came out to an 8.5 cap.
Okay. Yeah. Great. So you basically replicated the marketing package, and now you're going to adjust and kind of create your version of the truth and see what you came up with.
Correct. Let me just move my little piece out of the way here. So they wanted about 3.3 for it. So I came back with about 2.9, just over 2.9. The income was slightly lower because there was an increased vacancy based on the financials that I had at the time, which was earlier this year. It was actually under contract with somebody else, and the owner let the vacancy slip. That buyer backed out, and this went back on the market. So based on, I think it was April, May rent roll, the vacancy had dropped.
I see. Okay.
From the expense standpoint, it's pretty much the same outside of, the property management expense dropped a little bit because of the reduction in income. So that was my version. So similar scenario. So still looked like a pretty good deal, although, down to 2.9 on about an 8.5 cap scenario.
So you adjusted the income based on the actual rent roll you got, and then the expenses were about the same as before. But that reduction in income, you applied their cap rate at 8.52 to that new NOI, and you came up with 2.9. So that was kind of your first 10-minute offer. You said, hey, the 3.3 won't work, 2.9 will, but here's why. I took your NOI, I adjusted it, I applied your cap rate, and I came up with 2.9, and that was kind of your first offer.
No, exactly it was. Yeah, I got the email from the broker still, and he said basically the minimum is 3.3. So, from that engagement, I got the information, the intel that I needed to say, okay, if I want to make this deal work, it's going to be 3.3 million or nothing.
Mm.
So that's when I kind of went out to some other things. It's like, okay, so, from an offer standpoint, from a more sophisticated offer standpoint, kind of, pre-LOI still a little bit, but, adjusting the offer to about 3.3, I think I had gotten an updated rent roll, so they had leased a few more units, or maybe one or two more units. So that had been dropped a little bit. But for the most part,
the income still appears to have dropped. And now you had 554 versus even 562 from your my version. So the income has dropped even more, which would presumably reduce your NOI and your price. But it sounds like maybe you discovered some other stuff maybe on the expense side.
Yeah, a little bit. And it primarily went into, the management fee I have in here at 5%, that actually ended up being 4%. And this is kind of interesting because I got stuck right between the new version of the SDA coming out.
Right.
And so this was the old version, and then I can flip over to the new version here in just a little bit.
So it looks like your expenses actually went up a little bit. So my sense is to make 3.3 work, you probably modeled some kind of upside. Is that how eventually you made that 3.3 work? Okay.
Yeah, exactly. So I can jump into the P&L here,
yeah.
And you can see that, basically from
make that a little bigger. Greg, make that a little bigger as well. Yeah, perfect. So what? Yeah, what is the value add? What is the value? What did you do here?
Yep. So from a notes perspective, I raised the rents by a total of $10,000, and that increased my average monthly rent upwards. And then in year 2, I raised the rents by a total of $30,000.
Now, what is the value add? Why are you raising the rents from an average of $876 to $902, et cetera?
Mm-hmm. Yeah, so basically I'm going in there and improving the units. So the property manager that I spoke to has kind of like a standard upgrade package, about $3,500 a unit. Countertop refinishes, new bathrooms, lighting package, new door pulls, paint the cabinets, new flooring. And they've been pretty successful at doing that for a number of years in the marketplace. And he basically said that once you get that in place, the average rents will increase about $100 a month. And so I didn't take on that full monthly income. I actually split that between by reduction in vacancy as well.
Right.
Yeah, and you can actually see when I model it out in the newer version of the SDA, the rents will actually increase a little bit more from that perspective.
So really,
I got down to about 8%.
On the income side, what's happening is the rents are increasing slightly, but really the big value add is reducing the vacancy. Is that right?
Yeah, exactly. The vacancy and then the loss to lease that's out there and the concessions and everything like that.
Okay. Yep. And anything on the expenses, or the expenses were pretty solid?
From this version, the expenses were pretty solid. After I started getting into the deal desk and gotten a little bit more sophistication and working with Patrick and working with a lender on the different type of debt offerings that are out there, then that exposed some other items. So I can move over to that one here right now.
Yeah, we can. Before we go over that, so it sounds like you modeled kind of the business plan and the upside. And so at a $3.3 million on the summary tab, where did that put you, knowing what you knew at the time? And make it a little bigger.
Yep.
Yeah. So you're refinancing in year 2, and your IRR was like 30%.
Yep. Correct. And so it validated the $3.3 million price.
And it's largely because it was 25% vacant right now, and you're getting that to a market rate of whatever 10 or less. Is that what was driving the NOI and the value?
Right. So it's the improved units and the improved operations.
What was the issue with the property? Was it self-managed? Was it poorly managed? Or why was it so vacant?
Self-managed. The owner had a manager on site, had an office manager on site, but he was a direct conduit to that office manager instead of a professional management company.
No, that's fantastic. So yeah, we can go to the other SDA next, and if you guys, we're going to do a Q&A obviously when we're done here. So you guys get ready to ask some questions to Greg on this, and we're going to open up the new version of the SDA, the 2.6, that has the red light, green light in it. And it looks like, Greg, you've done some additional modeling in this version.
Right. So after the deal desk call with Patrick, he connected me with a lender and basically said, we can get to 20% loan to cost. We can actually roll in the price of the improvements into the loan. And so
with the 20%, you modeled initially with what loan to value? What was that?
The initial loan to value is 25%.
25, and then this is not only loan to value, but it's loan to cost, right? Can you explain
loan to cost?
Can you explain the difference between loan to cost and loan to value?
I can try. So loan to value is basically the debt, the amount of debt to what you're going to purchase it at currently, or the value of the property. If you get an appraisal back, the appraisal and the purchase price will probably be fairly similar, much like in a residential area. Loan to cost is the purchase price plus anything else that you want to do with it. So it could be improvements to the property up to a cap usually per unit, as well as even a significant portion of some closing costs too.
That's right.
What they call soft
and
costs.
Sometimes even your acquisition fees. So it
Yep.
basically, if it were 20% loan to cost, it could equate to something like 15 or even 10%. I'm sorry, 85 or 9% LTV. So
Yep.
the big question is do you want that much leverage on the property? So your returns are going to be higher, but you have much less cash flow. So it's one of those things you want to weigh. All right, good. So you got more attractive terms from the lender. So that's good. What else?
Yeah, and so I modeled that in there. So this is red because I basically didn't put the repairs into this line that wrapped up into the loan balance. Throughout that time, we got some improved financial numbers, and what I discovered was actually the vacancy wasn't as bad as it was. It was the loss to lease that was really bad. And so you can see that those percentages kind of flipped there. It's still about the same, but from an accuracy perspective, that's really how it flipped, as well as the other income had been reduced there. Oh, and sorry, I moved the Section 8 rent payments to the other income area.
Yeah. Okay.
So that's just to make everything a little bit more accurate. And then I applied my property management pro forma to this. So you can see that the PM fee went from 5% down to 4%. We actually increased the cost of payroll to provide more high quality staff on the property. And we discovered that the owner was paying flood insurance, which is about $20K a year in this marketplace. Yeah. And it wasn't in the 100-year flood zone. So there wasn't really, after talking with the deal desk and trying to weigh the risk and everything like that, we started modeling it without it, just to see what it happened. And we could always add it back in there, but we started modeling it without the flood insurance in there. Okay. But for the most part, other expenses all kind of stayed the same from this perspective. So this came out at about a 1.38 debt coverage ratio. So still pretty good on a 3.3 price. And as we move into the P&L now, so you can see that
make that a little bigger, Greg.
Yep, will do. Get to about 5 years here.
Perfect.
Yep. So you can see here that I've actually bumped the rents up even more after further discussions with the property manager on the area. So we were about $850 or so before. So now year one average was about $900, year two about $955, and so I'm getting closer to that $1 a square foot metric there, and then trying to bleed off some of the vacancy and the concessions and the loss to lease over time. I actually increased the vacancy here to account for unit improvements, unit turnovers, and everything, just from a conservative standpoint. Okay. And I came in here and modeled some additional rubs, about 10,000 in rubs from water there. And in this market, we can, when there's no sprinkler, we can rebill about 95% of the water charges. In addition to that, and working in conjunction with a loan and trying to get a specific type of debt, there's a Fannie Mae green program out there. And so that's going to actually reduce some of the costs of the water usage. So low flow toilets, water saving faucets, things like that. And they actually target in that green program about 20% reduction in water costs. So I modeled it over 3 years. They say you have to do it in 12 months. So spreading it out a little bit further than what I should be.
So Dino's comment was, this deal is getting juicy, Greg, and it is. By the time you were doing this kind of research, were you under LOI, under contract, or where, or was it? Did it never get to that point?
No, so I was under LOI. Probably, definitely when I was moving into the version 2.6, I went to the deal desk. I'd gone to the deal desk with the older version of the SDA. You put out the newer version of the SDA, and so I moved everything over to that version, had another deal desk call. They deemed it partner ready from the beginning, just to refine it. So I was continuing to vet everything with the deal desk. Try to get negotiations started with the broker. The owner was on leave for a couple weeks. The broker was on leave, getting married for a couple weeks right after that. So there's always something that comes up in these situations. So while everybody wants to move really fast, life happens, and you just got to stay with it and everything like that.
Yeah, so I mean, you were certainly you would negotiate around that 3.3 price, and that's
Mhm.
what gave you, I guess, permission to spend more time on it. And then you put your thinking cap on and started making phone calls. You started talking with property managers, and you recognized that the rents were actually higher than you thought it was. And then you started getting these green programs, and as you kept digging in, the deal started getting better and better, and it was because the owner had not been as aggressive as you were, even just researching this kind of stuff. So yeah, this looks great. So yeah, keep going.
Yeah, absolutely. So basically, the improvement program for the units would my property manager says takes about 15 to 18 months. So I've actually modeled that over a full 24 months here, as well as with the reduction in vacancy. So taking a very conservative approach, being my first real kind of deal, going to the deal desk with it, and Patrick helped. Pull that back in a little bit from that perspective. So that was really good. It's one thing to be conservative. It's another thing to be overly conservative and not necessarily realistic, because you can overshoot from that perspective as well with investors.
Yeah, that's right. So if you've covered a P&L tab, let's take a look at the summary tab, because I got to believe at this point the returns are probably through the roof.
Let's see if that's big enough there. Yep. So we're about 27% average annual return and a 21% IRR. And I think if I just jump into the returns tab real quick here.
Yeah. Make that a little bigger.
Yeah. So I did not project the refinance on this one.
Good. It's also more conservative too. So.
Yep. So I didn't project, because the intent was for the owner to get to 90% occupancy for 3 months. That's the kind of 90 for 90 is the industry term there. 90 days occupancy for 90 days, 90% occupancy for 90 days. And you can go right into agency debt, right. And not have to do a refinance or a gold bridge loan or anything like that. So that was the idea. And you can see that the cash on cash return actually dropped here a little bit. And that's because I had interest only for 2 years on it. Which kind of juiced the cash on cash return.
Show us how to model the interest only loan. How do you do that?
Yep. I'll zoom in here real quick. So in the first mortgage tab here, you got your standard, pulls your rate from your summary tab, which pulls from the scenario tab. You got the number of years as well, and then you just put in the number of months there for interest only. So I could have went 36 months as well.
And why are you? This is agency debt, meaning Freddie or Fannie debt. And why is there an interest only component?
It's because of the improvements. Because
okay.
So the amount of the improvements and rolling those costs into loan, they want you to be able to recognize those improvements and do those loans. And what you do basically is take off some of the principal portion here. So if I actually take this out, you can see that I'm paying about $3,800 a month in principal. So that's what my reduction would be.
Now,
from the interest only.
What happens to the returns if you remove that interest only?
Mm-hmm. Yep. We can just take that back and go back to the returns tab here. Really doesn't touch the average annual return of the IRR that much, but the cash on cash dropped about 1.5% or so, 1.2, 1.3%.
Yeah, but look at the first year cash on cash. It dropped from 11% to 6%.
Mm-hmm.
So that made a huge difference to the first year cash flow. Not so much overall, but certainly in the first year. So you got to decide what you want to do. Do you want to increase the cash flow in year 1 or 2, or do you want to start building the amortization up? And as you can see here, the end result is very similar. So you might argue for the interest only, because it has more cash, right? The more cash you have coming in, the more conservative it is. So this might be a good choice.
Yep.
Very good. What else?
Yeah, so I can quickly model here just what a refi would look like. I don't think it was terrible. Yeah, see, I only projected a 45% capital return on this.
Did you do the interest only loan back? It may have something to do with it.
Yeah, let me try to do that real quick. I'll do 24 months here.
Yeah, I go back, and then don't do a 2-year.
Actually dropped.
Do a 3-year.
Yeah, three-year it worked.
Yeah, now it works better, because now you're returning the majority of the capital back to the investors, all 77%. Mm-hmm. If I can read that, it's a little small, but
77.
And then you could hold on to this thing. You don't have to sell it in year 5. The investors already have 80% of their money back.
Yep. So you can definitely put it out to year 8 even and see what that looks like.
Yeah. It's excellent, right? 24%. So, yeah. I think we're getting close to the end here. So you guys start start asking some questions here. And Greg, I'll just ask you those questions. Anything else you want to show us before we get into the questions?
No, I don't think so. You could definitely tell the majority of the time I spend in the scenario tab and then refinement in the P&L tab. And that's really where the returns are going to come from, and projecting out that modeling.
All right. So Adrian's asking how you found the deal. You can take it off the STA if you want. You can take it off the screen share.
Yep, that's fine. There we go. I'll turn my video back on. You can see my lovely face. There we go. So I found it on. So I found the broker on LoopNet. They had another property listed out there. I was too late to the game for that one, but they said, "Hey, why don't you take a look at this one?" And so I went out to the website and found that, and inquired about it, and they gave me the materials, signed the NDA on it, and that's how we got it. So that's just awesome. Building that relationship. Yeah.
Hector says, I thought it was mandatory to refi in year 2 and not anything more than that.
Oh, so I think he's referring to the modeling of the year 3 there. So it's either year 2 or nothing, or year 1, year 2 or nothing. And Michael and I can debate this, but I definitely see his point. There's some risk to doing it too late in the game. For a small property like this, for a smaller property, 60, 50, 60, 70 units, you should be able to complete the rehabs, and the property manager should be able to complete the rehabs within that time. And then you want to get your equity back out of it.
So here's a bottom line. The deal can't rely on a refi in year 3, right? In this particular case, you have all kinds of options because the returns are so good, right? You could refi in year 2, or you could not refi. In fact, you model it without a refi at all. If you refi it, it boosts the returns. But let's say the reason we don't want to do this, guys, is we have to accommodate the possibility that there's some kind of market downturn in the next years. Who knows, right? Everybody says market cycles every 7 years. We're in year 9. Everybody says we're overdue, and maybe we are. Whatever, okay? So the way we're going to address that is we're going to not sacrifice our underwriting requirements, and we're going to be conservative with our assumptions. We're going to buy for cash flow, and we're going to make sure that we have conservative loans on there. I mean conservative, we're not going to do a 5-year ARM. That's how we got ourselves in trouble in the last recession. We're going to put a 10-year on there. Now, we're going to show a business plan that shows a 5-year exit, okay? Because investors don't want their money tied up for more than 5 years. So we're going to show them a 5-year plan. But if the crap hits the fan in 5 years, well, what are we going to do? Well, we're not going to sell. We're going to hold on to it. And we're going to ride it out because we have the cash flow for it, right? Because we can. So just because Greg is showing a refi in year 3, it doesn't mean that it's necessarily bad, right? But if the deal requires, and we've seen deals like this that require a refi in year 3 or 4 or maybe even 5 to get the deal done, and that's risky. What if we can't? Now, if we take that out and now the returns suck, it's not really conservative, right? But if the returns are good, you have all kinds of options. So Hector, I hope that kind of makes sense here. David's asking, what made you confident you could not only raise the rents but drastically reduce vacancy? And what is LTL as well?
Yeah, loss to lease, maybe.
Okay, loss of lease. Thank you.
So the property manager that I found via the same firm, but he was another partner at the same brokerage front company, referred me to this property manager. He's been in business. He's done property management all over the country. Been in this market for since 2001. Managed over 160 different complexes in this market. And managed 2 other complexes in this immediate submarket. So he without even asking, I mean, it just rolled off his tongue that this is what the rent should be. And he knew this property, he knew the management of it, and said, this is plain and simple what you need to do.
Yeah, and Ben has a related question. In addition to the property manager, who else did you speak to about this, if at all?
Really, just the property manager. I did speak to several other property managers, but they one was larger properties, over 100 units, and then several other ones were smaller properties. And so it just didn't give me the comfort level. Like, I mean, this 50 to 75 unit, that was this guy's specialty, what he's marketed in. And it just portrayed, I can read people fairly well, even on the phone. And I met the gentleman when I went to go visit the property. It just oozed out of him, like, this is what you need to do.
That's good, and it's a sign that you had the right property manager you're talking to.
Yeah.
Antonio is asking, how did you find out the loss to lease numbers if it wasn't showing the marketing package?
Yeah, absolutely. So it's based on the rents, on the current rent. So I did some analysis. My property manager did some analysis and said that based on this quality of unit, this is what the rent should be, and they were $100, $150 underneath that.
Yep.
So you could call it loss to lease. You can call it, you can model it from an improvement standpoint as part of the units, but it's technically loss to lease if you did not improve the units.
Yeah, that's right. Ed's asking, how is the down payment financed? And I got to say that it wasn't relevant yet because it hadn't gone under contract yet. So just to answer that question, that's something that we would have worked out, or that we did work out for this deal as we talked about the joint venture agreement, right? Yep. And so we kind of talked through that. We said, Greg, what do you want to do? The more you do, the more you contribute, the more equity you get. So you don't have to have a down payment. You don't have to fund the due diligence. But you can, and then you get more equity if you do that, right? So that's we just kind of worked through that, and we came up with the answer for that. Yeah, exactly. Hector's asking, how did you hear about the green program, and is it available all over the U.S.?
So I'd heard it from another podcast that I listened to primarily, and then his focus is more on the debt from the investment standpoint. So I'd heard about it from that, and then my lender said I had asked my lender about it as well, and they gave me a little flyer about it. I believe I posted it in Slack on the deal and DMM portal there.
Yeah, that's awesome. Joe was asking, since it was in Texas, did it suffer any hurricane damage? If so, what kind of damage and cost of repair?
So it was in Texas. There was a little bit of damage associated with it, but the big thing was the occupancy was falling off. Again, and that was kind of the major driver, where we're just kind of in pause mode right now and trying to work with the owner on that.
That's cool. All right, guys, I don't see any more questions. What are you working on now, Greg?
So I've got another place that the broker is not this broker, but a different broker is trying to kind of lead me on. It's about another 60 units. I'm going after 250 units in the same market as well. And then I'm in another market in Florida. Got about 800 or 900 units that I'm looking at across between 4 and 9 properties there.
Yeah, David's asking about the status of the deal.
Yeah, so basically just waiting for the broker or for the owner to get up to occupancy. I didn't really want to do a bridge loan with it, and so just kind of waiting month by month to see if they can start getting into 90% occupancy.
Yeah, don't be afraid to do a bridge loan, and we did it with a deal in Memphis. Yep. So don't be afraid, because if you can lock it up, the returns are very good. So if you have to do we're doing a 3-month bridge loan for a deal just like that, just so we can take it off their hands, even though it's aggravating to have to go through the costs and the expense of doing a daggone bridge loan. But if that's all that's standing between you and a deal, that's something to consider.
Yep.
So let's see. Antonio's asking, when modeling interest only for 24 or 36 months, how do you know you can qualify for this type of loan? Is it your choice to assume this?
I got the information from the broker, from the mortgage broker.
So when you bring this to the deal desk, as soon as if we accept the deal, one of the first things we have you do is talk to a lender, either one you identified yourself or one we'll send you to, because as you can tell here, the assumptions are fairly significant, right? Even a loan to value increase from 75% to 80% makes a humongous difference in your return. So if maybe they were a little iffy before, that'll push it into the green zone. So a conversation after your property manager with your lender is going to make a big difference. So again, that's why we say, as you're building your team, the 2 most important members are your property manager, number 1, and your lender, number 2, so you can bounce these assumptions off of them.
Yep.
Let's see, Hector, did the lender provide you the solution of rolling in the repair cost, or is that something you had to request?
I'm familiar with it from a residential perspective, but I did confirm it. Yeah.
All right. Carl Myers is asking, hey, when you refi, are you buying out the members?
No. When you refi, you're returning capital, technically. So you can write the agreement any way you want, I guess. But from a typical standpoint, at least engaging with Michael, you're returning that capital, a significant portion or all of that capital, and then the membership percentage and the ownership percentage would stay the same.
Yeah, I get this frequently, and it's theoretically possible. And I checked with my own mastermind group of syndicators, and while it's theoretically possible, no one does it, and it's because it leaves a bad taste in the mouth in the investors. Hey, I'll refinance your 3, and I'm buying you out, and thanks very much. Right? Now, you could address that by, for example, guaranteeing a minimum return. So if I buy you out, it has to be a minimum hurdle of whatever return. it's complicated. Now it gets complicated, right? And a confused mind says no. So while it's theoretically possible, no one does it. So which means then the question is, why the hell would you want to refinance then? Greg?
Yeah, well, I mean, you return the capital to the investors so they can then reinvest with you somewhere else.
Well, exactly. And it's also, when you're getting a deal done where you're telling the investors that you're going to have a liquidity event in year 5, and that induces them to invest with you. Now, it's up to you what you do in year 5. You can say, hey, so, I lied and we're going to hold on to it for another 20 years. Sorry. Thanks very much. And what you're doing is you're delivering on your promise of what you said you were going to do. And most investors are very happy if you return. That's why in the SDA it turns green when you return 60% of the capital, because if the majority of the capital is returned, their risk is off the table. And now they're just enjoying cash flow, and their cash on cash return is humongous. And they can take that cash and they can maybe reinvest it again, and now they get another return on the cash. So in other words, it satisfies the investor. And again, that's how you build your business, is by keeping your investors happy, by communicating well, by, and then they'll talk about you, and it'll be much easier for you to raise money. All right, let's see. All right, did the lender provide you the solution of rolling the repair cost, or is it something you had to request?
So I think I already answered this. So I'm familiar with it from a residential perspective, and I just vetted that assumption that I could do that with the broker.
Yeah. So Hector's also asking, on a year 2, year 5, how close is close enough if we don't want to hit the 60% return to investors? Is 55, 57, or 58.5 good enough? Hector, I don't know. Holy cow. It's really a guideline. Maybe these things should turn orange or something, Yeah. All these things are the red light, green light system is useful, but it's not set in stone. There's so many subjective things that can go on. And, there may be reasons that we don't like a deal for reasons that are not even, you can't even put a quantity on it. It's just a feeling, right? We've had some things where the numbers look pretty good, but there's a loan assumption that's coming due, and there was just a feeling of unease related to that, to a deal. And there's a lot of subjective things that go in, and this is where you have to kind of rely on our collective experience with this, where we say, look, you may not understand it right now, but it just doesn't look like, we just don't like the deal. And, we were working 4 months on a deal in Memphis also, and we finally walked away from it after having spent $10,000 on it and 4 months of it. And we finally walked away. And it was one of those things where the numbers worked, but just didn't love it. It's just, there's that feeling that you have. And my experience has been that you need to love the deal. Like, if you think about the deal, like, how do you feel? Does it stress you out, or are you excited? Right? Like, how do you feel about the deal? And if you're excited about it, then it comes out in the investors you talk to, right? But if you're not quite 100% excited, then people can sense that. And my counsel is, don't do deals that you're not excited about. If you're kind of going, I wish that weren't there. Now, you're never going to find a perfect deal, but you got to look at your own feeling when you're doing a deal. Anyway, that's my feeling on it. All right, guys, we're going to wrap it up here. Good turnout. Greg, I want to thank you for presenting deal, putting this thing together.
No worries.
And appreciate everyone here on the call. And if you're watching the replay, thanks for being a Deal Makers Mastermind member. And we'll do this again next month. So thanks all, guys. Take care.
All right. Thank you.